Hello and welcome back to another episode of Wealthy Expat. This week I've got the mighty Lewis Heaton on the show with me. Louis, how are you?
I'm very well, Chris. Thank you for having me back. It is an absolute pleasure.
It's always good to get you on the show. We always have a good time.
Yes, exactly right.
Exactly. How have things been? How are you finding things in Sydney at the moment? You managing with your lockdowns and keeping your mind at peace?
Yeah, trying to at least. I think we are I know for any UK listeners, it's probably going to sound, a bit of a junior lockdown, but I think we're entering day 100 soon. I'm not really sure. Keeping busy, but we can see the back end of it. I think we've got our announcements and stuff that we're going to start reopening and a few other, little treats in a month or two. But no, keeping sane, working from home.
Good.
I'm in the office, as you can probably tell. There's not this nice lighting in my house in Sydney, or nor a lovely painted wall behind me. But in saying that, I've ducked into the office to record this today, but still working from home, chipping away, getting into the groove of it now. So it seems like, it took us probably a little bit to get used to it, but now I think we're in full stride again.
Nice. Well, hopefully, about another month of lockdown the same for you, and then fingers crossed you're free again. Okay.
Hopefully, you guys stay out of it. It sounds like there might be some dabbling in of lockdowns again. Who knows?
I hope not. I'm praying. Fingers crossed.
Fingers crossed. Fingers crossed.
Exactly that. Well, today I thought it'd be good to get you on the show to essentially debunk some of the most asked questions when it comes to property investment, and then some assumptions that are made as well. I think this will cater to a lot of listeners, regardless of where you are on the scale, really, and just answer some of those questions that maybe sometimes some people feel a little embarrassed to ask, or it's something that they feel that they should know, and they're making the assumption then that what they are thinking they are correct in a sense. So we'll go through some questions. There's 10 kind of quick fire questions that we'll run through.
Let's do it. The most asked questions on the internet.
Exactly. That's it.
Let's do it.
We'll smash through them. But to start off with, let's start with the general kind of question that an investor might ask, and that is, why should I invest in property? And what's your opinion on this?
Top of line, I think that investing in property, when done, not correctly, but when done, well informed, and you've made an informed or educated decision about your investment, property is one of the safest markets to invest in, full stop. So, for anybody listening, when we talk about investment markets, it might be stocks, it might be cryptocurrencies, might be NFTs, it might be property, something you're investing in to see a return on your money, and property, I could probably say around the world, in most countries, especially when we're talking about the UK or Australia, it is one of the most, it's a hard real asset to invest in. And when done correctly, you can see a strong return on your investment for the life of an investment as well. So it's going to keep on giving. It's like the gift that keeps on giving, if done, as I said, well educated and when you've made an informed decision. That's why I think property is why you invest. And people have their different whys or why they do, as a result. But at the same time, why I'm going to go off the question of why choose property to invest in, say, over something else. I think it is one of the most, if not the most stable investment you can make.
Yeah, I think that's a good way of putting it. It's funny, actually, when I used to work for a financial advisory in the past in London, and we'd sell property, I was working on investments at the time for the company. And the way that we'd speak to some people about it and give, just to give you a bit of almost analogy to property. But when you go to the pub, you're not going to go into the pub and talk about where your pension is or what your pension's doing for you, or how your fund's performing. But if you go into the pub and you're talking about your property, people start to get jealous about hearing about someone invested in property and seeing strong returns on capital growth and having a strong rental yield coming in on the property. And I think it's almost like a stigma to the property, to owning some property. You want, it kind of, I don't know how to put it in a simple way, but it's just owning that piece of property. It gives you a sense of purpose, and you've got, like you were saying, that real property asset that you can physically touch.
Bricks and mortar,
Yeah, and you can see what it's going to do for you. So I think that's a very good way of putting it.
No,
Now,
I agree. One more thing to that. It's it's a very, as you said, it's when you go to someone, it's a very statement investment. You know, everyone feels like they can buy a stock. You know, everyone feels like they can buy something, whatever it may be as an investment. Let's go a cryptocurrency or a IT investment. But when talking about property, it seems that it's held at a very high regard because it takes a long time to save your money to buy a property, or it may take some people a long time to save. It may take some people a long time to commit to buying a property. So when you say you've bought one, it's often or not held in a very high regard in comparison to other investments.
Definitely. I think that's, good way of putting it. It's a statement in a sense. It's a proud statement. Like you were saying, it takes a while to gather that deposit. It's not a couple dollars that you're being thrown at something. It's a substantial portion, and it's taken years to get to that point to be ready to do it. So I agree. Cool. Next question. We are thinking, what have we got here? So we've got, what will it cost me to buy an investment property?
Okay. A to B, let's label it out. So we go, let's put a dollar figure on the property. Let's go $500,000.
Yep.
AUD. So we're talking Australian dollars, $500,000.
Yep.
Let's go from the day you commit to the day you get your keys.
Okay.
And now in this instance, we'll talk about something that's off the plan. So we'll talk about a property that is completing in, let's go Christmas Day this year. So we've got now until Christmas. So we buy a property today. What are the costs that we're going to incur? Or that would the amount of money we need in cash, or let's go cash for now. Let's go a dollar figure in cash. So top of line, in 90% or 95% of the cases when buying property, we're going to need a 10% deposit to exchange and go unconditional on our contract. So that means we're going to need 10% of the total purchase price. So let's put from $500,000, let's put 50 grand down as a start.
Yeah. There
are some markets in Australia and some developers will have a 5% deposit now to commit, and then 5% remaining at settlement, when, for example, when you get your keys. But let's go 10%.
Yeah.
So that's $50,000. We're going to incur some solicitor fees and conveyancing fees. Let's put them at $2,000. Around about $2,000 in Australia for a solicitor and a conveyancer to go over your contracts, to make sure everything's in order, and to go on to bat for you. And that's in that instant. Now, other costs related, really, there are some minor costs when we're talking about when we're coming to settlements in some minor costs in some depreciation schedules and some landlords insurances and whatnot. But we'll leave them out. We'll put them at we'll put them capped at, say, $1,000. So what are we up to? $2,000. So what are we up to now? $54,000.
Yeah, exactly that.
54. Now, one thing that we all know, which you're probably going to mention, or which you're probably going to remind me to mention, is your stamp duty payment.
Oh, is it?
Yeah, stamp duty is a big one, especially for a buyer in New South Wales. When you commit to your property and you go unconditional on your contracts and you exchange, that stamp duty is payable within, I believe, 2 to 3 months post that time. So that means your stamp duty, and for this example, or for this circumstance, let's say they've got no concession. Let's say they're not a first home buyer. They're buying. It's hard because we've just labeled the property at $500,000. But let's say there's no concession. The stamp duty payable will be before settlement. If we're settling at Christmas, that means we've got, it's going to be around about, we could do the calculator online as we go, but let's say $20,000 for New South Wales. So that takes us from 54 to 74, and that's it. And let's go $75,000 roughly. Again, this is not financial advice. This is a completely made up scenario. But it gives you a good idea that for about a 500 grand property, we're going to need from anywhere between $70,000 to $80,000 if you don't have any other properties and you're just using cash. Would you agree?
I'd agree. I think that's a good way of breaking it down. Obviously, like you said, it's not financial advice, but it just gives you some numbers General numbers really from if you were to get into it with no concessions and trying to purchase another investment property.
And absolutely. And we always like to leave a buffer as well. Like you always like to, you don't want to go to your wit's end and spend, or, be by the dollar of just affording something, because, which I'm looking through our questions here. We'll touch on another question about valuations in a little bit, but we want to make sure that we have a little bit of cash reserve just in case anything happens, just to be safe.
Definitely. I agree. Did you include transfer of titles there?
No, that's another one. But yeah, that's another one to be there.
Yeah,
let's make it for 500 grand. Let's go 80 grand.
80 grand. Yeah, I think that's a fair assumption. And these are just general numbers, so don't quote on this. Everyone's situation is going to be different.
100%. There's often concessions. There's often different things, different fee types and whatnot. But as a top of line figure, that seems, it seems about right. With a property of $500,000 with a 10% deposit.
I think so. And of course, there is opportunity to get in at a lower deposit as well, as you touched on. I guess the stock in Joiner at the moment is a prime example of that. The opportunity to get in there for about $35,000. So yeah, there is opportunities at different levels, but just as a general overview, that's the sort of numbers.
That's it. What you said there is probably a really good way of underlining how, like, from the general eye, or when you're looking at it, you see developer incentives, or we talk about 5% deposits, or we talk about, the NAB, for example. Here we go, the NAB scheme. They were going to do for first home buyers 5% of the deposit, and they were going to cover the other 5%.
Right.
And people think, what does that mean? Or what is a developer and joiner when you're buying house land pack? What does that mean for them to say that it's $35,000 deposit on, say, a 550 grand property? Well, it means that we've just gone from needing $80,000 minus 25,000. So now we've gone from 80 to 55 pretty quickly.
Yeah.
So this is why these incentives get snapped up often or not very quickly. So we start talking about the government incentives, or we talk about developer incentives, or we talk about bank incentives. And, when NAB did their 5% deposit scheme, these incentives get taken up very quickly. And I would always suggest, if you do have the ability or the capability to go ahead and utilize them, do it. Like, if you have the chance to do it, 100% do it while you've got the chance. Because now we're noticing, when all these incentives are gone, you realize that, for example, in Victoria, when the stamp duty concession went, so that was 50% off stamp duty. Now people are, having to fork out another $20,000 to what they, could have been doing, pre or last financial year.
Exactly. I think that's a good point. A very good point. I think these government, like in the UK, we've had a government incentive, which is the government-backed 5% deposit mortgages. And yeah, you have the government signed on your mortgage agreement and you're on your paperwork. But at the end of the day, it's helping you get into the property market. And you've got to take advantage of some of these. Obviously, be cautious at the same time. But if you're in a position and you want to get into the property market and start investing, then it's a good opportunity to get in at a lower entry point, in a sense, from your side.
Absolutely.
So definitely. Cool. That leads on to the next question quite nicely. Is how do I know my property is going to grow or increase in value?
The bottom line, or to be very blunt and honest, is you don't. But you can do your checks and balances. You can do your due diligence by making sure it does, with making an educated and informed decision prior to purchasing it. But the reality is, you don't know it's going to grow. Because it grew 10% last year doesn't mean it's going to grow another 10%. Because you're buying onto an area that grew 8% last year doesn't mean it's going to grow 16% the next year. Because you bought into an area that went backwards 2% doesn't mean it's going to keep going backwards, or just because it's not going to start growing. So making sure that's clear to me is that you can read online the area did well. And obviously that's history, and you should always take it into account. Has an area done well year on year on year? It's a pretty good indication, but it's not guaranteed. So you can't guarantee or assure your property is going to grow. But at the same time, Chris and I, we always talk about the drivers that affect high growth, and they are population, employment, investment in infrastructure by the government, your supply and if you nail four key drivers, let's go, as we said, employment, population, investment, infrastructure, and supply. And when we're talking about these, we mean the population growth. Is the population growing? Is it declining? Employment, what's the employment levels? What are the demographic? What is their employment status? And what are they doing for work? Investment infrastructure by government, for example, healthcare, education, road upgrades, good connectivity. For blatant example is a train line implementation of a new train line to great connectivity. And then looking at supply of the area, is it oversupplied, is it undersupplied, and coupling that with demand. If you do those 4 things, if you do those 5 things, and you check and they check out, and you're not overpaying, which is a pretty obvious one. If you're not overpaying for the market rate, then I do think there is going to be some growth for you, for sure.
Definitely. I think I think like you just touched on, I was going to raise the point as well, but looking for these areas of population increase that are going to see that population growth, or have they seen a decrease in population, just identifying where the good areas are, and then what's driving employment to the area. Are we seeing employment growth in the area? Is there infrastructure projects directly involved to that pocket? And will that help drive employment as well? And then looking at the levels of supply, which, like you touched on, Intel is going to drive some of the demand for the area as well. 3 factors will drive the demand for the area. So yeah, I think there's some things to be, I guess, considerate of when you are looking at an investment, and it's a good starting point in a sense for an investor.
Would you agree that I've been recently thinking that, from my perspective as well, in my own personal experience, I think I've overlooked the population growth. I think I've overlooked what population growth will do to not only an area, but a local economy, but to property prices. I've always been very big on investment in infrastructure, road upgrades, connectivity upgrades. And of course, when governments push money into areas, in matter of fact, they're most likely to grow. Now, I've always not overlooked population growth, but I think that I haven't given enough credit to how indicative of high growth, or of the result of population growth will be of high growth. Now, it's a hard one to gauge, especially in Australia at the moment with COVID times, because we're predicting immigration to be huge once the borders open back up, and we look at international students and international demand. So it is a hard one to pick, but I always think, for me personally, at the moment, I've overlooked the strength of population growth in the past, and I'm sure I'm not going to do it the next time.
No, I agree. It's probably, I'm similar to you. I guess we come from similar backgrounds. So spending in infrastructure has always been kind of the top of my list when I'm looking at investments. But when you
probably causes population growth. I guess that probably causes population growth. But
although when you think about it, it could almost be the other way around. If they're seeing strong population growth, then the government's thinking, okay, let's put infrastructure.
We have to upgrade a road. We have to implement a train line. That's actually, that's a really good example of Northwest Sydney. Like Northwest Sydney grew strong and fast in their population and didn't have a train line. Then the government brought a train line in. So yeah, you're probably right.
Yeah, it's interesting which way you look at it. But I guess nonetheless, they all complement each other. And if we're seeing the result of one, it's more than likely that you'll see the other 3 in tail following behind. But cool. So the next question is, do I have any obligation to live in my investment property?
Absolutely not. So you can buy a property and never live in it. Yep. Never see it. You can buy a property, never touch it. Do you want to elaborate on that? Do you want to talk about what the positives and negatives are if you did live in it?
I guess from a tax perspective, that's one thing that we've got to remember. I think that once, and you can probably elaborate a little bit further on this as well. But the fact that with an investment property, if it's serving just an investment purpose, it's a lot more tax effective at the end of the day. And that comes from the deductions that you can make on the fixtures and fittings, and then also on the bones, the bricks and mortar, the building itself. And that at the end of the day is going to help your cash flow from an investment perspective. Once you walk into that property and you live in that property, and correct me or tell me if I'm wrong, but once you've lived in that property for, or within the first 12 months of settling on the property, you then can't claim as much on the depreciation of the fixtures and fittings. Isn't that correct?
It's a tricky one. It's a tricky one. One thing, we'll come back to that, but one thing to note, not jumping away or skipping that point, is what living in the property will do. And when I started off really strong, saying you don't have an obligation. You don't. But to Chris's point of maximizing your tax deductions, or your ability to not pay tax, would be to a key one for me is capital gains tax. Now, we talk about property like we're not going to sell it. And I am a strong believer on, if you can afford to hold, just hold. You know, I've sold things in the past that I shouldn't have sold. You know, for example, I've sold a pair of shoes that I shouldn't have sold. That I should have just held on to them for the life of their time, and they've become more and more valuable over time. A property is the number one thing for this. If you can afford to not sell, I get it, some properties aren't working for you. It might have been a bad call. It's not a good investment. Of course, you can ship them. You can get rid of them. But if you can afford to hold it and it's rising, then just keep holding. But if you did want to sell it, you can avoid paying capital gains tax if you were to occupy the property for 12. I might have got this wrong here. For 12 months within the first, you got to live in the property for a certain amount of time within the first 2 years.
Yeah. Yeah.
And then there's a window of 7 or 8 years where you can miss capital gains tax. You can sell, for example, for listening at home, if you bought the property 500,000, it's a tax where you pay a tax on the uplift value. So if you then sold it for $800,000, you're paying a tax on that uplift.
Yeah, okay. It's interesting. This question is probably quite relevant for my mother at the moment. She's looking at purchasing or tossing up whether to buy an investment property or something that she's going to call a family home, and one day be the kids' property. But at the moment, we're going back and forth almost daily at the moment, and she's thinking, but do I have to live in the property and I don't want to live out there? Or what benefits do I have if I am living in it, and what benefits do I have if I'm not living in it? But it's just, I think, making people aware that, of course, you have no obligation to live in it. You could live in it if you want. There's nothing stopping you from living it.
It's a good fallback plan if things go wrong. You can always move into it.
Exactly that. And then, like you touched on with the capital gains tax as well. But there's, I guess, it's just you have to know what you want from your investment. And if you're looking at an investment property, in most cases, you're looking at it to grow you grow your portfolio for the future, in a sense. And that's one way that I'm looking at it with my mother, almost looking at it as though it's a pension to her. It's the fallback option at the moment. So, when she's retired, she's living the life on the Sunshine Coast and relaxing. She's got this, say, it's $600,000 property that's ticking over, paying the mortgage, is essentially paying for itself with the rental income that's coming in. It's growing in value year on year. She's seeing strong growth from it. And that's sitting there, in 10 years time, it might be worth, let's say, $1 million. And then she's got that kind of fallback, in a sense. If everything does go belly up and she needs somewhere else to go, she could move into the property at the end of the day. And
exactly, that's a prime example of a successful investment. A successful investment.
Yeah. So cool. Okay. The next question, and this one is a bit more open, you could say, but should a property have a positive yield?
Where do you start? Okay, so a positive yield means that your property is putting money in your pocket, really. So you're yielding a positive. It's probably not the best worded question. Is your yielding on it's positively geared? Who knows? But let's just, for example, let's say, should you go for a yielding property versus a equity or capital gain or capital, capital growth sort of strategy? Yielding properties are often not found when a rental yield is your rent per week times 52. So your rental per annum, rent per year, and you divide that by your purchase price. Then you found out a percentage, and this percentage figure you'll probably read online, and it'll say Sydney's average yield's 3%, lower in some instances. Queensland's average yields, we look at 5% now, 5.5%. Melbourne, very similar to Sydney, 3.5%, in some cases 4%. But the old story is or the how you could probably word this, the not correct way, but how it usually goes is that if you have a high yield on a property, the less chance it is going to grow. So people always come to us and they say they want a good yield, and they'll say they also want it to have high growth. Yeah. It's like a golden egg. You're probably never going to get it. In some cases you do. It's very, very rare, but when the yield is high, it means that the asset is riskier. And this is most certainly the case in commercial property, industrial property. When it's got higher the yield, the asset itself is riskier. Now, I think a good yielding asset is fantastic to have if you want to buy one or two properties and be done and don't invest again. They're often not going to pay themselves off. For example, your mum's your mum's case, circumstance. And if and it's going to pay itself off, and you're not too worried about using equity to buy again or to refinance and buy again. If you are looking for a property to help your cash flow, and say you've got 3 or 4 capital growth strategies, so you've got key properties in areas, in blue chip areas, and they haven't got the best yield, so we're paying money out of our pocket per week to service the debt and the mortgage. I think that getting a nice yielding asset can amend that or can fix that. And then you could start diversifying your strategy a little bit. But it's a bit of a long-winded response by me here. I don't mean to, blabber on too much, but I think that in some cases, it's very particular, but in some circumstances, a positive yield or a good, let's just go, a strong yield is probably the better way to put it, is great and is ideal. In other cases, a strong yield just won't come with your property that you've bought in a capital growth, a capital growth strategic purchase in an area, for example, like your eastern suburbs of Sydney. You're going to see real low yields, sub 3%. Other areas in Sydney, you're going to see yields of 4%, but often not. That's because the capital growth isn't going to be there.
Yeah, of course. For people who want to be like the mighty Lewis Heaton, what would you pick if you were going to go and invest today? Would you go for yield or would you go for capital growth?
I would go for capital growth. Why? Because I'm more interested in seeing a property grow in value, and I can cope with it being a little bit negatively geared. I can cope with putting money out of my pocket to service it. But I know that in 2 or 3, 4, maybe 5 years, let's go 3-4 years time, or I'm going to knock on the bank's door and say, I want more money to go buy property. I want to get another loan by refinancing because I want to buy again. I want to be quite aggressive in my investments. I think going for something today, not outlaying too much of your capital, like not outlaying a lot of your money in your pocket, and picking up a nice asset that yields 3.5-4%. 4% yield. Take it. Yeah, run with it, and then that's in a nice area of 6-7% growth. I mean, that's your golden egg right there.
Yeah, exactly. So finding those gold mines. That's what we've got to keep an eye on there. Eye out for.
And don't worry, you'll miss them. Like people will, excuse me for a lack of better words, but people will shit on you when you point out a property investment or you say that this is an area that could grow. People will always, it's the classic Sunday night dinner table. No. But we've seen it time and time again over the past 2 years, especially, I'm just going to go start of pandemic till now. We've seen it time and time again, over the past 20 years, that area or that property you thought had all the key drivers, had everything that you thought was going to turn out to be a good investment. It does turn out to be a good investment, and unfortunately, you didn't buy it. Yeah. It's the age-old story.
I think Brisbane's a prime example of that at the moment. All the hype that we're seeing for Brisbane, I guess the level of interest in Queensland at the moment, and how quickly stock is getting snatched up. But in a sense, Brisbane presents almost that hybrid opportunity at the moment. I guess you're getting some relatively strong rental yields. You're looking at let's say 4.5 to 5%, conservatively, really. And then capital growth. And with the Olympics being announced, I think that they'll be seeing some very, very strong capital growth over the next 10 years. But like I spoke to Peter about last week, really, it's now Queensland finding its next opportunity, or harnessing this opportunity that they have and creating more from the city to put it on the map more. It needs that global recognition to go to the next, in my opinion.
And I think that the Olympics will, I say this a lot, I don't think you can base your investment off an Olympic campaign. But at the same time, if you look what happens to host cities, especially Sydney in 2000, you look what happens 5 years prior, 10 years post. Yeah. It's not your golden ticket to success. But at the same time, the government piles in money. You know, the government will pile in infrastructure. The government piles in, and then people will say, yeah, but how does a new stadium help my property grow? Well, the new stadium is going to bring a lot of eyes, going to bring a lot of people, and these lot of people are going to spend a lot of money in your local economy. Going to start pushing the local economy. Is going to start feeding more business. That creates more job opportunity. You know, and then we touched on it before. That'll give more incentive to the government to upgrade the road, to upgrade a school, to put in a new, to cater for the demand. So it's a great story, as you said, the Brisbane story. And I think that the way they handle it over the next building in and then working their way out of the next sort of, let's go a 15-year bracket, will be very interesting to see if Brisbane can be hitting, or standing in the ring with your Sydney and your Melbournes. Yeah,
like to see it. I think the opportunity is there, but they're just
some people don't believe in it, but
exactly.
Some people do.
Yeah. Sam's one of those. Sam, inside, if you're listening. Okay, so next question: what is a valuation? That might sound quite simple, but yeah, what is a valuation, Louis?
A property valuation. How do you? I mean, Chris, while I'm speaking, pull up the legal definition of a property valuation. But in my experience in history, a property valuation is a value of a property given by a professional, being a property valuer, based off his findings and research into the property, and it's an extensive report they will do. And he'll give you a value of a going market rate, of a going. Am I close?
Yeah, you're pretty much on the spot. He says valuation is a quantitative process of determining the fair value of an asset or firm.
Fair value. Yeah.
Exactly.
So a valuation in our world means that really is the dollar figure that your property is valued for, and we come into valuations in our world is big when we start talking about obtaining loans, when we start talking about getting our finances approved, when we start talking about, what we're going to need to pay. So valuations in a sense, you'll get your property valued and you may do nothing with that. You can pay a value to come out, he'll value your property, and it'll probably give you a good indication if I'm going to sell it, this is what I'm going to get. You're never going to, when we're talking about properties, a valuer will come out and tell you your property is worth $1 million. It doesn't mean you're going to receive $1 million. You've got to go away and sell that. But he's giving you a good and an expert and a professional opinion, not a professional report and findings of, in his opinion of the findings, this is what the property is worth. Yeah. So vows can be very tricky, and they have to be navigated with caution in. When we're talking about getting finances approved and a few other things, but talking about valuations, please talk to a valuer. They are certificate and certified, and they have, I did at university, I did my vows degree. So I've got my checks and balances. If I wanted to be a valuer, I still have to go work in the valuation field for, I think it is now 2 or 3 years to get signed off. So it's not just, you can't come straight out of university and become a valuer. You still have to do your time. But these people are experts, it's not, people get confused with getting a market appraisal, getting an appraisal done. An appraisal can be done by a real estate agent, I would get like a real estate agent. An appraisal means in their opinion of comparable sales in the area, this is what your property's worth. But a valuer is it's a lane of its own.
Yeah, definitely. I guess a question that can tie in quite nicely with evaluation, and this might be something that you've come across recently, but I guess sometimes your val isn't going to stack up to where you'd like it or where you're thinking it's going to be. And sometimes it happens more often than not with investment properties. It can happen a little bit. But what would you tell a client if the val has come in undervalued and you've got a gap to pay? Because it's not, in my head, it's not something to be concerned about. It's almost part of the process at the start, in particular with an investment property. But what would be your kind of take on that?
I think you've just got to be. Vows are the worst because it can put you back, $10,000, $15,000 if you. I think the only thing to say, the answer to that would be you've got to be prepared.
Yeah.
Most circumstances, and in most cases, your vow will come on contract price. If you've done, if you've bought well. To say, you've bought it's come on contract. And this is when we're talking about something, you've bought something off the plan or you've built a new home as a house and land package. If it comes in short, there are ways around it. And I'm sure that you need to be, I think the best answer to this without sounding too wishy-washy would be with a very good, know your mortgage broker and be partnered and be working with a strong, a well-versed and a very experienced mortgage broker, because they can be assistance to that. And also at the same time, in the front end, be selecting a property that is going to give you the best possible chance of a vow to be on contract price or maybe above. But
I agree.
But be prepared. If a vow comes in short, it's
something to
can be very detrimental. But it's if you can weather the storm, don't think it's going to be like that for the rest of your investment journey.
Yeah, and don't see it as the end of the world. Yes. Yeah, exactly. Don't see it as that. It happens, and there are ways around it in a sense. Okay, the next one. How long should I wait before I sell? There's not really a right or wrong answer with this. I guess it depends.
No. I think that I think we may have touched on that before. So I'll be very quick without sounding too harping on it. I think you should always hold on if you have the ability to hold on to property. I think hold. Don't sell because the market's only going to grow.
Yeah, exactly.
It's not going to keep rocketing in a direction that's unfathomable. But I mean, the people that in 10 years' time,
you're going to see strong growth regardless. I think.
But if you do need to sell, if you do need to sell, then when should I sell my property? I would take into account capital gains if you've lived in the property, which is good. Take into account your taxes. Take into account where the market's at the moment, and be. I can speak about this personally at the moment because my mother and father just sold our family home and they're moving into another place. No kids there anymore. They've downsized from their place at the moment. They bought a little place. But in saying that, one real estate agent told them this. That's where they thought the market was. They gave it to the young kid who was on their tail about it, doing work. They gave it to another agent, and he sold it for a significant amount of money more than they were appraised. And I said, Mum, that's not. It might have been the market. It might have been where it is, but it was an off-market opportunity, so there wasn't many offers coming in. But to this point, when I say when should I sell, that maybe hold on. But if you are going to sell, make sure you are seeking the best advice by your real estate agents as well when you're going to sell.
Definitely. No, that's a good point to make. The next question, Louis, is around what does a solicitor and or conveyancer do in regards to my investment property?
They will review your contracts. So they will review your contracts and imagine them as, if you're the boxer, imagine them as your cornerman. So in your corner, if you're the boxer, in your corner, you should have an expert mortgage broker, an expert solicitor conveyancer, hopefully us at Wealthi in your corner as well, assisting you with the purchase. But the solicitor conveyancer will iron out all the parts of the contract and amendments to make them, or to make the contract as in your favor as much as possible, or as much as they can do.
Yeah.
So
your best interest.
They're working in your best interest, and they will be working with the developer solicitor. And the developer solicitor will be working in the interest of the developer, of course, but they're on your team. So they're going into bat for you. So they're in the contract. They're looking at every part of a contract that comes with it. Sunset dates, talking about where your deposit's sitting. Is it sitting in a trust account? Is your deposit being utilized? There's lots of things we can go into, but your solicitor and conveyancer will come in to the purchase process of an investment property. When you have got your contract, they will sit you down and go through the amendments and what they would recommend and talk you through the contract. So I would always advise going with a strong solicitor or conveyancer to do that for you.
Definitely. They're going to be your best friend at the end of the day.
100%. And I'm not sure it's a solicitor or conveyancer. I would have to check up on this as well, but some people will go ahead and sign the contract themselves. Some people will not seek advice, but I would always say get a solicitor and conveyancer involved to review the contract, talk about all the amendments, talk about everything to walk you through it. Their fee, as we mentioned before, will often not be, let's go a massive ballpark figure. Again, it can vary with solicitors and conveyancers. It can go anywhere. Let's go $2,000, $2,500, but it is in your best interest to do so.
Yeah, no, I agree. I think that's a good way of putting it. They're going to be your best friend. They're going to help you get the best terms on your contract, or try their 100% best to get them. So at the end of the day, a very beneficial part of the team.
Absolutely.
Another member of the team that we might consider on some occasion, but would you recommend to a client to use a buyer's agent?
Well, I mean, use Wealthi. There you go. Use Wealthi. I think that Wealthi, I'll give us a plug. I'll give us a shameless plug here. We are a completely free service to use. We identify and qualify investment opportunities across Australia, in key capital markets, and tailor make strategies, plans for you, matching you to the best property possible. And at the same time, we're a one-stop shop, so we can, you can tap into our services and use our partner mortgage brokers, solicitors, conveyancers, the best in the business in each and every state. But beside the point, buyers agents are great. Buyers agents often will 100% of the time charge you a fee. They'll take a percentage of the purchase price or a fee in some way to use their service. I think, to put it bluntly, I think that seeking advice is in your best interest as well. You can read a lot online, like you can read copious amounts of information. It can get quite tedious. It can get quite bring on some anxiety. Am I doing the right thing? Am I making the right decision? Am I buying the right property? Am I looking at the right investment area? Am I talking to the right people? Do I think that by not talking right? If you're talking to someone who, they may have been recommended, they may have got some review, they may have they live and breathe this stuff all the time. So I think seeking advice is 100% the way to go. I think talk to us before you talk to anyone else. Again, completely free service. Don't take any money off you. And you can tap into our expert level of knowledge in an array of different areas. So would you agree? I think that getting advice is good.
I think that it also depends on the type of asset you're looking for, in a sense as well. So if you're looking at investment opportunities, investment properties, come to people, like speak to Wealthi. We're not going to charge you a fee, and we're going to guide you through the process. We want to help you get on the property ladder and buy your first investment property. If it's your first or if it's your fifth, we want to help you, and we're not going to charge you a fee, but we'll hold your hand and find a property that suits what you're looking for. So in a sense, you could say that we are a buyer's agents from that sense. But then if you're looking, say you're in the eastern suburbs in Sydney and you've got a criteria, a list of things that you want to hit, and you're looking for a quality asset, a lot of the time, some of these buyers agents are given stock off market before anyone else has had an opportunity to look at them. So you can get in early and, get an opportunity to put an offer in on these properties that are quite exclusive, and you might not get an opportunity to get your foot in the door if you were going to wait until it comes to market. So I think it depends on what you're looking for, but from an investment perspective, I think that, by all means, come to us, come speak to us.
Absolutely.
We'll be able to help you. So,
and be very careful in who you select. Be very mindful of your who your buyer's agent is and their experiences.
Yeah, definitely. I agree. Well, Louis, that is the questions for today.
Right, the top 10 questions. They lived up to expectation. I really liked it.
We should do a monthly segment on most asked questions for the month or something.
100%. Yeah, the most asked questions. That was. I hope you all listening got a good takeaway from that, or a piece of information.
Yeah.
Please reach out to Chris and I if you want any more updates or questions from that top 10. I think we covered a lot.
We did. I think that was good. And thank you everyone who has tuned in tonight. It's been a pleasure to speak to you, Louis. And I look forward to the next catch up. And everyone that did listen, don't forget to like, comment, and subscribe. And we will keep you posted on the next podcast. But thank you again, Louis. We'll speak soon.